Hello everyone, this is Nilesh Shah from Nilesh Shah Financial Services. Today I want to talk something about every construction business owners who cares about their business, but many do not plan for early enough. Tax savings, but not just tax filing, not just giving documents to your CPA in March or April and hoping for the best. I'm talking about strategic tax planning throughout the year. Because in construction, your numbers move fast. 1 month cash flow looks strong. Next month, payroll is due, materials are due, subcontractors are waiting, equipment needs repair, and the bank account suddenly feels tight. And then tax time comes. That is when many contractors say, I made money, but where did it go? Why is my tax bill so high? Could we have done something earlier? The honest answer is yes. Many tax savings are created before the year ends, not after. That is what we are going to talk about today. I want you to imagine this. A construction business owner has a great year. He is busy, his crew is working, jobs are coming in, customers are happy, revenue is growing. On the outside, everything looks successful, but behind the scenes, he is overwhelmed. Receipts are sitting in the truck. Material purchases are mixed between debit card and credit card. Some subcontractor payments are recorded, some are missing. Equipment payments are not properly separated between loan principal and interest. Honor draws are mixed with business expenses. Job costing is not clear. Then tax season arrives. He sends everything to the tax preparer at the last minute. The tax preparer does the best they can with what they have. But now the business owner hears the number, you owe more than expected, and he feels frustrated. Not because he does not want to pay taxes. Every business owner understands taxes are part of doing business. He is frustrated because he did not have visibility. He did not have planning. He did not have clear numbers early enough to make smart decisions. That is the difference between tax preparation and tax planning. Tax preparation looks forward, tax planning looks forward. Tax preparation looks backward, tax planning looks forward. Here is a big message for today. Construction companies do not just need bookkeeping for tax filing. They need accurate numbers so they can make better decisions before tax time. Before tax savings are not created by guessing, they are created by planning. When your bookkeeping is clean, when your job costing is accurate, when your assets are properly tracked, and when your CPA has good information early, your business has a much better chance to reduce tax liability legally and ethically. This is not about cutting corners. This is not about being aggressive without documentation. This is about making sure you are not overpaying because your records are incomplete or your planning started too late. Now let's talk about maximizing deductions. The first area is the deductions. Many construction businesses have legitimate expenses and they are not always captured properly. Think about it. Materials, tools, equipment rentals, fuel, insurance, permits, software, cell phone, vehicle expenses, safety gear, training, subcontractor payments, professional fees, office expenses, small tools and supplies. These expenses matter, but here is the problem. If the books are messy, deductions can be missed. And when deductions are missed, taxable income may be higher than it should be. Let me give you a simple example. Let's say your construction business has $2 million in revenue. After labor, material, overhead, and other expenses, your profit is showing $180,000. Now imagine there are $40,000 legitimate business expenses that were not properly recorded. Maybe receipts were missing, maybe credit card transactions were not categorized correctly, maybe some business expenses were paid personally and never reimbursed or recorded. If those expenses are missed, your profit may look $40,000 higher than reality. If your combined tax impact was around 25%, that could roughly mean $10,000 of unnecessary tax pressure. That is real money. That could help pay payroll. That could buy materials. That could help strengthen cash reserves. That could help the owner sleep better at night. Again, the goal is not to force deductions. The goal is to capture what is real, properly documented, and allowable. Clean documentation. This is where many contractors struggle. They are excellent at building. They understand the job site, they understand crews, schedules, suppliers, deadlines, and customers. But paperwork is not always their favorite part. And I understand that. But here is the truth, tax savings need documentation. If you want to deduct something, you should be able to support it. That means invoices, receipts, mileage records, vendor bills, subcontractor records, loan statements, payroll records, and bank statements. Good documentation does two things. First, it helps protect the business. Second, it helps your accountant and CPA find opportunities with confidence. When the records are clean, planning becomes easier. When the records are messy, everything is guessing, and guessing is not a tax strategy. Exploring tax credits. The second major area is tax credits. Many business owners understand deductions, but they do not always understand credits. A deduction reduces taxable income. A credit may reduce tax directly depending on qualification. That is why credits can be powerful. For construction businesses, there may be opportunities connected to energy efficiency, commercial buildings, accessibility improvements, hiring, equipment, or other business activities. But this area is complex. Not every contractor qualifies, not every project qualifies, not every expense qualifies. That is why planning matters. For example, if your construction company is involved in energy efficient commercial building work, there may be specific tax opportunities that need proper review, certification, and documentation. But if you wait until after everything is completed and no one tracked the details, the opportunity may be missed. The key is simple. Before you assume there is no credit available, review it. Before you assume you qualify, verify it. That is how smart tax planning works. Strategic asset management. Construction businesses often invest heavily in assets, trucks, trailers, excavators, skid steers, tools, machinery, computers, office equipment, software, shop improvements. These purchases can have a major impact on taxes and cash flow. But here is where planning becomes important. Just because something gives you deduction does not mean you should buy it. I always like to say, do not spend $1 just to save 25 cents in taxes. That is not strategy. That is emotional decision making. The better question is, does this asset help the business make more money, save labor, finish job faster, improve safety, or increase capacity? If yes, then we look at the tax strategy. Should it be depreciated over time? Should Section 179 be considered? Should bonus depreciation be reviewed? How does the purchase affect cash flow? Is it financed? What is the monthly payment? What happens to profit? What happens to taxes? This is where bookkeeping, CFO advisory, and tax planning work together because a tax decision is also a cash flow decision. Construction businesses are unique. You are not just selling a simple product, you are managing projects. Each job has labor, materials, subcontractors, equipment, change orders, retainage, progress billing, and timing differences. That means your profit can be misunderstood very easily. One job may look profitable, but the final margin may shrink after labor burden, rework, callbacks, or unbilled change orders. Another job may create taxable profit, but cash is still stuck in receivables or retainage. This is why tax planning for construction cannot be separated from bookkeeping and job costing. If job costing is wrong, profit is wrong. If profit is wrong, tax planning is weak. If tax planning is weak, the business owner may overpay taxes on or make poor decisions. Simple example for contractors. A contractor does $3 million in annual revenue. The net profit shows $240,000. That is an 8% profit margin. Now, after reviewing the books, we find a few things. Some equipment interest was not separated correctly. Some small tools were categorized inconsistently. Some subcontractor payments were missing W-9 follow-up. Some vehicle expenses were not reviewed properly. Some owner paid business expenses personally and never recorded them. Some jobs were underpriced because the true labor cost was not visible. After cleanup and planning, maybe we do just find tax savings. We also find profit leaks. That is the bigger picture. Tax planning is not only about reducing the tax bill, it is about improving after tax profit. Because if we can help a business, construction business, save $20,000 in taxes, improve pricing by $40,000, reduce waste by $15,000, and manage cash flow better, total impact can become meaningful. That is how a business can potentially improve after tax profits by $25,000, $200,000 per year or more, not by magic, not by tricks, by better numbers, better planning, and better decisions. Here is something very important. You cannot wait until tax season to do all of this. By the time the year is over, many options become limited. That is why year end planning is powerful. Before the year closes, you can review how much profit is the business expecting, are estimated tax payments on track, are all expenses managed properly recorded, are there any major equipment purchases being considered, are accounts receivable and retainage properly reviewed, are payroll records accurate, are subcontractors properly documented, are loans and assets properly recorded? Are owner draws separated from business expenses? Are there any credit opportunities to review with a CPA? This is proactive. This is strategic. This is how business owners stay ahead. In our profit and cash flow analysis, we look at the financial picture from multiple angles. We look at your bookkeeping. Are the books clean? We look at your profit. Is the profit real or are expenses missing? We look at cash flow. Is money stuck in receivables, retainage, or unbilled change orders? We look at job costing. Do you know which jobs are actually profitable? We look at tax planning opportunities. Are deductions being captured? Are assets being tracked properly? Are credits worth reviewing? Is your CPA getting clean information early enough? We look at decision making. Can the owner make confident decisions based on the numbers? Because the goal is not just to prepare reports, the goal is to give the owner clarity. Clarity creates confidence. Confidence creates better decisions. Better decisions create stronger profit and cash flow. So, here is my message for construction business owners today. Do not wait until tax season to think about taxes. Do not wait until tax season that your bank account feels tight and your cash flow is tight. Do not wait until a job is finished to find out whether it was profitable. Start planning earlier. Keep your books clean, track your jobs properly, document your expenses, review your assets, work with your accounting team and CPA before the year ends, because strategic tax planning is not only about paying less tax, it is about keeping more of what you earn. It is about building a stronger company. It is about protecting your cash flow. It is about making sure your hard work on the job site turns into real profit in your bank account. If you are a construction business owner and you feel like your revenue is growing but your cash flow still feels stressful, this is exactly why we offer our profit and cash flow analysis. We can review your current financial setup, identify possible profit leaks, review tax planning opportunities with the right professionals, and help you create a clearer path forward. Our goal is simple: help you increase your after tax profits by $25,000 to $100,000 per year or more through better bookkeeping, better planning, and better financial decisions. Thank you for watching. This is Nilesh Shah from Nilesh Shah Financial Services. Let's build stronger numbers, stronger cash flow, and a stronger construction business. Thank you.